Hey, what's going on, guys? So today I wanted to share the top DeFi opportunities that I believe exist today and heading into 2026 as the market is kind of calming down and maybe we're shifting towards a bear market, right? Prices have been pretty cheap, but as you can see, there's still a lot of total value lock in the market, right? So let's talk about the broad overall trend here and each category. There's a few different categories that really stand out to me. The first one is lending is still at number one for quite a while now. And like always, this is not meant to be financial advice. I'm just sharing what I've learned and hopefully it helps you along the way. And some of the broader trends that I have been seeing so that if you're looking for more investments, if you're buying altcoins, or if you are yield farming different protocols, this could potentially help you out. And at the end of the video, I'll also share some yield farming opportunities that you could look into if you are looking for yield. And so the first category is lending. You can see during the last cycle, it's about almost 50 billion, right? And right now it's at 55 billion. So we retrace a little bit and the peak was almost at 92 billion, right? So lending has been growing pretty rapidly throughout the last few years. And of course, if the market draws down, because a lot of these lending protocols do hold crypto assets, the total value lock would drop as well, right? But you can see it's setting a higher high and hopefully a higher low here as the market draws down. And protocols like Aave has been around for a very long time. If you hop into Aave, you can see just a huge growth in the total value lock as well as the fees and the revenue that they've been able to generate. And then there's also other protocols like Morpho as well. And one of my favorite is Maple Finance. You can see that the total value lock has climbed pretty rapidly at the end of 2025, the Q3 and Q4 of 2025. And if we look at the revenue here and look at the monthly revenue, you can see it's been almost at like a million per month, right? So really solid here. And what I really like to look at as well for DeFi Llama is that if we are looking at the quarterly earnings, which is the profit of the business, right? If you think about the protocol as a business, which it pretty much is, one really neat thing about DeFi Llama is that you could see this quarterly earnings growth, right? So throughout 2025, Maple Finance did really well. The first quarter was only one something percent, but then they had like a 43% growth. And then the quarter after, 100 something percent growth. And then another 53% growth. And we're currently in Q1 right now. And if the earnings trend is kind of the same as the last few months, I think they will also have another growing month here because it's February 10th right now as I'm filming this, and the revenue is already at 1 million, right? So there's still 20 days left in the month. And a lot of these protocols, they would make more revenue if the market is tanking or if there's a sharp decline because they generally make the money from liquidation fees as well, right? And another neat thing about DeFi Llama is that you could see where the income goes with this chart, right? You could see their total profit margin is about like 11%, and some of it is distributed to the token holders, right? So if you want to buy their token syrup, then you want to be looking at those metrics, comparing the valuation of the token, the tokenomics, and how much value Maple Finance is able to accrue to those tokens, right? But it is a growing niche, in my opinion. You can see the chart is setting higher highs, right? And again, hopefully a higher low. It just makes sense that lending is a growing market if there's more and more DeFi adoption. If it's just going down, then it just means that DeFi is not really getting adopted because lending and borrowing is just one of the core functions in finance, right? And another big category that has seen a lot of growth is liquid staking and restaking. Restaking has been kind of flat over the last few years because the yield for restaking has dropped by quite a bit. And liquid staking protocols basically allow you to earn the staking yield without having to run the validators yourself or do the staking process manually, right? So it makes staking much easier. And most people just use liquid staking with stuff like Lido Finance, or if you're using Binance Stake ETH, you could do that. There's Jito Sol for the Solana ecosystem and a bunch of other liquid staking protocols, right? And again, it's really good that this is growing, even though as the price is declining. And people are just drawn to more passive ways to earn yield. If you guys have never used liquid staking protocols, then be sure to check that out and learn what it is. It's an important part of the DeFi ecosystem. And I think a lot of people would just prefer a way to earn yield without spending a lot of time or thought behind it, right? Because things like concentrated liquidity, there's a larger learning curve. And if you don't know what you're doing, you could lose a ton of money. Versus liquid staking is you're just basically, if you're staking ETH, you're earning more ETH over time. And let's say over 10 years, you're going to earn more ETH than if you didn't stake your ETH. And of course, there's stuff like smart contract risk and the staking risk that is associated as well. But it has been a category that has been growing. And one of the most bullish category is the real world asset category. The RWA, you can see everything is kind of red here except for like this risk curators. And the RWA category is up by 26%, right? And you can see the chart is just going up and to the right. This is the main driver of growth in DeFi, in my opinion. It's the tokenization of different assets like treasury bonds, real estate, stocks. Every financial asset would be put on chain, and then it's going to be more secure, more transparent, and people using the blockchain, we could be earning yield from that as well. Some of the assets like on those tokenized stocks and the X stocks, and as people trade those assets, you're making the trading fees, right? And you can see XAUT, especially with gold actually climbing up in price pretty rapidly over the last 1 to 2 years. It's actually at 167 million right now, which is quite a lot. Tether Gold, PAX G has been around for quite a while as well. And then there's T bills, bonds, and money market funds like this BlackRock build. And then there's also US Yield Coin and these other tokenized assets as well. So that's something I'm really looking forward to. There's already a lot of tokenized asset opportunities that you could be yield farming like gold. I believe there's an XAUT and PAX G pool that is pulling a pretty high APR right now. And last I checked, it was like 20 to 50% APR, but that is probably a temporary spike. Most of the time, it's hovering between 5 to 15% APR on gold. And as long as PASG is safe and XAUT is safe, you're not suffering any impermanent loss in that scenario, right? And you're just earning yield on gold. Versus if you're just buying a gold ETF or something or physical gold, you're not going to be earning any cash flow. But of course, with DeFi, you're taking on custodian risk and different risks like the smart contract risk. And if you don't know how to manage your positions, then that could also be another risk that you're taking, right? And another category that I want to go over is basis trading. So basis trading protocols is something newer this cycle. It kind of climbed pretty rapidly, but then it dropped pretty rapidly as well recently because the yield has been going down. So basis trading protocols typically has a lot more yield when the funding rate is really high, the positive funding rate, right? There's a lot of longs in the market. Longs from Perp's platform are paying the shorts, and a lot of these protocols basically stake some of the asset or hold some of the asset spot, and then they would be shorting the asset to make the delta neutral yield, right? So this is protocols like Athena and Falcon Finance, I believe, runs a more diverse strategy. So they're not just using basis trading, they have a lot of other strategies. It's basically an on-chain hedge fund, and that's another trend that we're seeing as well. There's basically more and more on chain hedge funds where they're earning yield from either basis trading or different types of yield generating activities, right? I think there's a protocol called Neutral where they're doing OTC deals with a lot of different altcoins and then they're shorting it to get that delta neutral yield. But there's also the risk of the token basically increasing in price too much and then it's not unlocking fast enough, right? But basically, basis trading and on chain hedge fund is also another category that you could look into. And I do believe that you should be looking into these if you are investing into these protocols or you're depositing into these protocols and not just listen to me or other people, right? Because you can be catching something that I did not catch. I could be making mistakes and a lot of these other people could do the same as well. So be sure to do your own research. And if you guys are watching this channel, you're probably providing concentrated liquidity, right? So Dexus, unfortunately, actually did not grow that much as the total value lock is kind of flat here over the last few years. There's a couple reasons why I think that is the case. The first reason is that altcoins did not actually take off that much compared to last cycle. There's a lot more on chain liquidity from altcoins, and prices were surging really high. But maybe the token amounts were not that much, but because the prices are high, the total value lock is also going to be higher as well, right? And a lot of the dexes do hold much more altcoins than like assets like Bitcoin. So it makes sense that this cycle we did not see that much growth. And also, a lot of people are trading on different platforms like Hyperliquid or other perps platform. So they might not be trading in the dexes directly. And for dexes, I believe that a ton of yield farmers just don't know how to provide concentrated liquidity as well. They don't have a strategy or a system in place. So it's very likely that these longer term yield farmers would lose money over time, right? I've seen a ton of people that have been in DeFi for a very long time, like 5, 6 years into DeFi, and they still believe stuff like, for example, yield farming concentrated LPs is not worth it because of impermanent loss. There's no way to manage it or beat it. It's just very hard to manage. So then it's not worth it to do. But in reality, they might not know like the exact math behind it or profitable strategies that you could actually use, right? And sometimes there's also people promoting really high risk strategies, show you a bunch of high yields, but then those strategies are not really sustainable long term as well, right? And because I'm building Drippy, it's part of my job to talk to liquid providers. I've seen it times and times again. People lose money because of unsustainable strategies. They don't have a good system in place, and they might not understand some of the more niche concepts behind concentrated liquidity, right? And that's why I created a whole course behind it and a community behind it. And also, we're building some software to actually help you make everything easier. Currently, you can't get access to the community. We're prepping for launch. We should be launching pretty soon, maybe in the next 1 to 2 weeks. So keep an eye out for that. If you haven't signed up for waitlist, be sure to sign up because you're going to be getting a discount compared to people that might be joining much later down the line, right? This is mainly what I focus on in DeFi because I believe that concentrated liquidity is one of the best way to earn yield on your assets, especially for assets that might not have staking yield. A lot of different altcoins don't have staking yield or the staking yield is really low. If you know how to provide concentrated liquidity, you could be looking at like 25 to 50% or even 75% in some cases for different altcoins. And for major assets, you could be looking between like 5 to 15% for more conservative strategies, right? And if you're prioritizing cash flow versus capital gains, you could be looking at 20 to 40% on blue chip pairs like ETH to USDC as well. So I think DEXs would grow in the future as more and more people learn how to LP. There's just not a lot of good educational resources on LPing out there. And that's why I created this channel in the first place. There's a lot of people that ask me about, like, okay, how do I LP? How do I set the ranges? How do I actually manage my positions? That's why I created these videos to help you guys out. And hopefully you get some value out of it. And we lose less money together when we're LPing, right? So Dexys, we actually have like 1900 protocols, which is pretty crazy, right? Compared to these other categories. Most categories are not breaking 1,000. So Dexys is a more competitive landscape. But at the same time, a lot of DEXs are not multi-chain. Aerodrome, for example, is on base, but then they're expanding to be on ETH mainnet and trying to become multi-chain. There's only a few multi-chain DEXs, for example, PancakeSwap and Uniswap. And if you're interested in DEX tokens, I would definitely look into Uni, Cake, or Arrow. And then there's other ones you could consider as well, like Pump. It's not directly a DEX token, but it is related to trading. There's a lot of opportunity there, in my opinion. And especially if more and more people are trading on chain, we could be looking at more volume and hopefully more profits for these protocols. And you want to make sure that these protocols are passing back like the value to the holders as well, right? And there's also other protocols that I believe would do really well heading into 2026 as well as 2027 and beyond. The first type of protocol is the more consumer focused protocols that allow you to do stuff with crypto, stuff like EtherFi. There's like the EtherFi cash card where you could load crypto into it and then you could basically spend it like a credit card, right? It's more like a debit card. You have to have a balance in there. But if you haven't used it before, it's actually really easy to use. You can just send your crypto there. And then after you sign up for the card, you have to KYC. And I'm not sure if it's supported in all countries, but It's actually pretty widely supported. You could do stuff like Apple Pay, or in Asia, you could use Line Pay, right? Using the EtherFi card. So it makes buying stuff really easily. And I believe if you get the physical card, you could also withdraw some cash from the ATM as well. So I think protocols like these that has a lot of consumers using it and a lot of crypto people using it, I think these protocols are going to do quite well. You can see the revenue they generate is pretty steady. So that is one type of protocol that you could look into. The more consumer focused protocols, right, that is likely to just stay around for a long time. And as more and more people are using crypto, then these functions are actually really important, right? Because it's just a hassle to be on ramping and off ramping crypto all the time. And sometimes it's just really easy to just load your money into the card, send your money there, and then you can spend it on whatever you want, right? Especially when you're yield farming, you're earning some fees. You could just send some of it when you harvest your fees every single month, and then you could use that card really easily. And another big category that I believe is very important in crypto is just anything that facilitates either trading or gambling, right? There's just a bunch of degens in crypto. That's just a space, right? And during the last cycle, a lot of protocols that were focused on basically NFT trading did really well. And this cycle, Pump.Fund did really well because it's into the meme coin trading as well as Hyperliquid. The purse trading is doing really well. They're added stocks and metals as well. So you could be trading gold and silver and different stocks on Hyperliquid. So Hyperliquid has been doing quite well. And then they're also adding prediction markets, right? One of the bigger prediction market is Poly Market. You can see there's like 358 million total value locked, and it's generating an annualized $30 million in revenue. So it has been growing pretty rapidly over the last year or so. I personally don't trade on Poly Market. I think it's a good opportunity if you know like something more niche, and that's also a good way to actually earn some income. But at the same time, any form of trading, you're taking on risk. So you got to be comfortable with that. And you got to know how to manage your risk, how to trade to actually make it a profitable thing. I personally, again, am spread too thin. I'm not trading poly markets, but it's just something to look out for. And that's also another bullish catalyst that is on Hyperliquid, right? If you guys hold some hype, I believe that the prediction markets on Hyperliquid would also be adding to the revenue that Hyperliquid is able to generate. And they're using 99% of the fees to buy back the hype token, right? So that's pretty much the overall categories that I am bullish on for 2026 and beyond. The first one is really simple. It's lending and borrowing. Protocols like Aave has been growing and dominating the market, and there's also newer ones like Maple Finance, right? And then real world assets, I would look out for that as well. There's a lot of opportunities to be yield farming, tokenized gold, and stocks. And then there's basis trading protocols or on-chain hedge funds. Dexus has been kind of flat, but I believe that if more and more people learn how to LP, that total value lock would climb as well. And as more tools are developed for yield farming concentrated liquidity, I think more and more people would be more comfortable yield farming, right? Because I think that's still a pretty big bottleneck for concentrate LPs. A lot of people don't know how to assimilate their positions, how to actually scan for the best pools. There's a lot of dumb liquidity where they're depositing in the pools that are not optimal, right? It's earning less yield than different pools that have the same exact asset, like ETH to USDC, for example, right? And then there's the consumer focused apps like EtherFi. And then lastly, anything that basically facilitates trading or gambling, hyperliquid, prediction markets, that kind of thing. I think it's going to do really well long term because they're going to be earning a ton of fees off of the trades or the gambling, right? So before I hop off here, I do want to share a few yield farming opportunities. I've shared it with the Drippy community already, but the first one is just a very simple crypto to stable pool, right? If you're starting to deploy into the market, you could be looking at stuff like ETH to USDC. If ETH is an asset that you're comfortable to hold, maybe over the next 3 to 4 years or 5 to 10 years, I think ETH is at a pretty good price. And one of my favorite indicators is the weekly RSI. I use the 25 period RSI. You could go into settings here to change. But basically, when it's below 50, it just means that the prices have been trending down pretty aggressively. And that's when I tend to look for buying opportunities, right? So You can see throughout the bull market, even right when it's below 50, that's when we typically get the best prices. And of course, we could dip lower too during the last cycle. When it's hitting 50, you can see it's trading at about like 2,500 to 3,000. But then we ended up going to sub $1,000, right? So that could always happen. But at the same time, buying at those levels are going to be much better than like buying all the way up here, right? So that's the main idea. And if you are yield farming ETH to USDC or crypto to stable pool, the lower your entry, the more capital gains you're going to have. And as prices trade above your entry, you're going to be in profit throughout the whole process, right? In US dollar terms. And I am using a pretty low leverage strategy here. I'm depositing some Bitcoin and some ETH onto Aave, borrowing some USDC, and then I'm using USDC in a $2,000 wide range. So it's a tighter range than what I normally would go. And this is because I am using leverage and I would be generating more fees. And as prices trend up, I would not be suffering any impermanent loss on my assets, right? My ETH is not going to be converted to USDC, and I could repay my loan pretty comfortably. I call this strategy the bull lever. Just search on my channel if you want to learn more about that strategy. But I am actually buying a pretty low amount, and this is for the client portfolio that I help manage. And you can see I have a plan in place of what to do if the prices hit a certain level. And this is really important, especially if you guys are using a leverage strategy. This is because you don't want to be caught with your pants down, right? If prices go down, you need to know exactly what you're going to do. Otherwise, when it's going down, you're going to suffer a ton of stress. You could be capitulating your positions, and then you could be selling your assets and realizing a ton of losses if you don't have a plan in place, right? So if prices go down at around like 1300, I would probably expand my range to stay in range a bit longer. And that's typically what I like to do if I want to stay in range longer. And I could basically expand the lower bound, but also the upper bound. I need to expand it much higher as well to be able to have less impermanent loss if prices bounce back, right? What I don't want to do is expand only the lower bound. A lot of people do that, right? They do like the snuggle rebounds or whatever rebounds that they do. They expand only one side, but then if you do that, if prices do bounce, you're going to be ending up with less asset than what you started out with. So the entry was around like 2100. It's not a big deal if it dips lower. I do expect the market to kind of drift lower. And in the worst case scenario, I could always withdraw that capital and add it as collateral as well, right? So with this particular position, I am depositing about like 60K worth of assets, and then I am borrowing 10K. So it's like a 6-to-1 ratio, and it's a pretty safe ratio. If prices do dip pretty aggressively, again, I could always withdraw, repay some if I need to, or add it as collateral and kind of loop that. You can see it's this position here. And I did add some other stable coins that we had on the side here into this E to USDC pool. So it has about 16K rather than just this 10K borrowed amount, right? But you can see the rewards are going to be much higher than whatever borrowing costs that I would be incurring. I just took this out a few days ago, I think. So there's about like $2 worth of interest, but this position is earning $20. And what I also like to do with this type of setup is have other positions that are generating fees as well. So I could be de-risking more aggressively, like this hype to USDT position is earning a nice roughly 25% APR on a really wide range. So I could use whatever cash flow this is generating per month to pay back the loan and maybe add to some Bitcoin here because we are a little bit light on Bitcoin compared to ETH. And then there's also the sold to pump pool that is not shown here because Rabby only has EVM wallets, right? So those are the positions that I'm using. And again, if you are using leverage, you have to go really light and be really careful about it. And another opportunity that I would be implementing is just a regular crypto to crypto pool, stuff like ETH to Bitcoin. If you don't like using leverage, that is a great option as long as you're comfortable holding one or the other asset, right? If you set a wide range from 0.017 to 0.05, that is probably going to keep you in range unless we start kind of trending up or down pretty aggressively. You could always expand to stay in range longer, or you could have a Nesta setup where there's a tighter range here and then you do a wider range, maybe from like 0.09 to like 0.01 or something, right? That is a Nessa setup. And you could just dollar cost average into those positions as well. The reason why crypto to crypto pool is such a great opportunity right now, especially if we're heading into the bear market, is because if the prices start to bounce and we start to trend up again, you're going to have much more capital gains compared to people that are purely doing crypto to stable pool, right? So crypto to stable pool might have a slower drawdown, a more shallow drawdown, but when prices do bounce, your portfolio is going to be bouncing less than people that are having more crypto to crypto pools. So at this point in time, I'm more comfortable shifting to more and more crypto to crypto pool rather than having much more crypto to stable pool, right? And of course, you could still have some crypto to stable pool if your priority is to maybe generate more cash flow and then protect your portfolio. It's all based on how you want to structure your portfolio. And again, I'm really bullish on real world asset and tokenized assets. You could be yield farming stuff like PaxG to XAUT that I talked about earlier, right? You could go to Revert and then just search for these assets. I typically like to use this 1 month period. And then I could hop into the pool and then see, okay, how much these positions are earning, right? And you could click on the age here and look at the range. You could just copy the range here. Basically, if your range is a little bit wider, it's generating about 11%. But some of these tighter range that has been in range for the last 11 days or so is generating about 42%. So 10 to 40%. That's roughly the range that you're generating on gold. So this is really solid, especially if you are bullish on gold and you want to accumulate some gold. That's also another option that you could consider. So this video is kind of getting pretty long, but that's the three main opportunities that I just want to share with you guys. One is just a simple crypto to stable pool or using some leverage if you are holding more assets and you know how to manage leverage properly and you know exactly the risk that you're taking with leverage, right? And the second is just dollar cost averaging into more crypto to crypto pool as the prices trend down. And then lastly, there's tokenized assets like gold, and there's also stocks. You can look at like the Ondo stocks. There's quite a few pools, but it's pretty high yield and really good to farm as well. And if you want to join Drippy, we are launching soon in like hopefully 1 to 2 weeks. Hopefully there's not a lot of problems that comes up when we launch. But basically, it's a community for yield farmers. There's a DeFi blueprint course, and I want to update that course, but I'm still waiting on some of the software side to be done so that I don't have to keep updating the course. And then there's also the software suite that we're building, stuff like simulating internal loss, simulating different positions, and portfolio tracking and stuff like that. That is taking a bit of time, so that would come later. But we're slowly going to release one feature at a time. So keep an eye out if you want to join Drippy. If not, just enjoy the free content I put out on this channel. Hopefully these videos help you out, help you become a better yield farmer, help you get more consistent results. Thank you once again for watching. I'll catch you on the next one.